What's up, everyone? It's Scotty with MoneyVest. So, this is it. Today is the big day. We've got PayPal earnings coming out. I want to go over everything we need to watch going into these earnings and what are going to be the three most important things for me as an investor who is down substantially on PayPal. These are the three things I'm looking for from these earnings and the earnings call and the new management that's taking over. But first, let's go over some horror charts. This right here obviously is going to be the horror story of PayPal, down over 83%. And you just can't win them all, right? And I know that I get comments talking about PayPal and Enphase and a lot of these companies, a couple of them that come to mind, right, that are down substantially. Now look, in investing, you have to understand you're not going to be right all the time. If you believe that you're going to be correct 100% of the times, you are playing the wrong game, okay? Because of the market's volatility, because of so much data, so much variables at play, it is impossible to be correct all the time. And when we look at companies, like, these are not bad companies, okay? These are not terrible companies, because on the channel, on MoneyVest, we talk about how we're only going to look at high quality businesses, right? So business, by high quality, I mean companies that have pretty good revenues and earnings and cash flows and profits. You'd never find me talk about like a speculative penny stock or a stock that's not profitable or trading at a really, really low market cap, like, that can be pumped and dumped. Like, we're not talking about any of those companies. So, yes, there will be bad picks, but we have to understand that as long as the businesses that we're looking at are high quality, the long term, right, is going to be pretty solid. You're building a process and a track record of looking at high quality businesses and companies only, right? Because that is going to create a system which is going to be winning over the long term. And I do believe, I have conviction in both Enphase and PayPal, the long term, they're still going to be very solid businesses. The stock price may disagree in the short term, 1 year, 2 year, 3 year. There may be instances where the stock price goes down, right, after I buy it, but that's normal, right? If I start getting rid of every stock, just because it's down from the moment I bought it, I'm not going to own anything because every stock can and will potentially go down after I buy it, because that's how prices move. But our goal isn't to just trade on the price. Yes, there's a technical side to it, and you can actually trade, right, if you are swing trading or if you are day trading. But if you are investing for the long term, price is very meaningless, right? Price should be meaningless because it's really the value of the company, and what you're looking at from a business standpoint is what really matters, right? And, as Buffett says, right, if you're not willing to hold a company for 10 years, don't even think about holding it for a minute, right? That's what it is. You're basically a part owner in the business, okay? We have to look at it from a long-term investing standpoint. You're basically buying the company as a shareholder, right? You're going to be a business owner if you actually invest in these companies for the long term. So, that being said, let's dive right into it. It all comes down to this one person. So Alex Chris, he is going to be taking over. He has already taken over, and this is his first earnings, and we are very excited to learn more about what he's going to say after the earnings come out during the earnings call. Former Intuit series, senior executive, oversaw small businesses and self-employed group, and also did help Intuit's successful $12 billion acquisition of MailChimp. So definitely coming from a similar domain, because Intuit also does help with, financial management and tax advisory, right? We got TurboTax, we got Mint, we've got a lot of different services, MailChimp, that kind of fits in that domain where PayPal is, right? PayPal, obviously payment processing, global leader with a significant amount of market share. We'll talk all of those things, but kind of fits. The fit is good, right? It's a good fit in my opinion. But of course, what the company ends up focusing on is what's really going to matter, right? You can bring on the best CEO, but if the company's vision and the execution isn't right, it's not going to do anything. So let's take a look at the second quarter summary. We got revenue at the high end of the guidance with 24% non-GAAP EPS growth. For the most part, most things have been growing. Transactions, 6.1 billion, 10% increase, 54.7 transactions per active account, 12% increase. Non-GAAP operating income, 20% increase. We got total payment volume. Now, this is probably the most important number right here, total payment volume, or TPV, because that's really what drives their overall revenue, right? So TPV is driven by transactions and engagement. So, and of course, number of users. So it's kind of like a ladder where the first thing is total users, transactions, and engagement. which basically drives their TPV, total payment volume, and then total payment volume drives their revenue. And then revenue, of course, we can extrapolate everything else like earnings and expenses and cash flows. So revenue was 7.3 billion, up 7 to 8% on a year-over-year basis, the second quarter numbers. And free cash flow was negative due to the impact of the European buy now, pay later loans originated as held for sale and expected to be sold in the second half of 2023, which they already did. I did a video. They sold it to KKR, which again kind of talks about the strength of the overall business. So I do think that they might see a pretty significant jump in free cash flows on a year-over-year basis. $4.9 billion in a trailing 12-month basis for the company, and non-GAAP EPS 24% increase, and the first half of 2023 non-GAAP EPS growth of 28%. This right here, PayPal has a global two-sided network at scale and is one of the world's most trusted brands. So 400 million active consumer accounts, 35 million merchant accounts, $1.4 trillion in total payment volume, and 24 billion in payment transactions as well. This is kind of like their portfolio of assets. Now, I will talk more about, why there needs to be more product offerings and more services that PayPal needs to offer. And that's going to be one of the three things that I think Alex Chriss should be focusing on, is how they can partner with other providers, with Apple, with Amazon, with a lot of these companies, and offer other services to boost their existing offerings and bring in more people to the network, because that's really what matters, right? Last year, we learned the PayPal kind of ditched their overall vision of focusing on new active accounts and instead shifted it to engagement, which has done really well, right? But I think it should be both. You just can't, ditch the overall sort of focus on bringing in new people and just focus on engagement. I think it should be both. Yes, you can lean a little bit more towards engagement if you want, but I think it needs to be the goal to bring in more users to the platform. Like, that just needs to be the goal. Like, that is, I would say, business 101, right? Everybody wants more customers. Yes, you can have higher engagement, but I think the focus should always be to grow and expand with more customers. This right here, total payment volume. So because of higher engagements, TPV has kind of held up really well, 377 billion in the second quarter, up 11%. And, this is what's actually interesting, is that PayPal's numbers are actually not bad. Like, they're really good if you think about it. But it's just because the active accounts have been slightly going down over the last couple quarters. That's what's causing the price to drop significantly, even though the TPV, the revenues, the earnings, everything continues to be solid. And that's what's actually interesting. And again, active accounts, 431. So you can see the last couple quarters, they've gone from 435 to 433 to 431. And that's really what's spooking a lot of investors. But engagement is up and TPV is up, and revenue is up like 7 to 8%, $7.2 billion coming in, and non-GAAP EPS of just over $1.16 per share, which again has been very, very strong, just a little bit over $1 every single quarter over the last 4 quarters here. Non-GAAP EPS growth of 28% in the first half. And this right here is the guidance. Now, all I'm looking for is a reiteration in guidance. If you can raise guidance or reiterate, I'm going to be happy. 20% non-GAAP EPS growth and just under $5 in earnings per share, which obviously does put the company right now trading at 56 at the moment. 51. Wow. 51 divided by 495, we're looking at a 10.3 price to earnings multiple, and divided by 51, we're looking at a 9.7% in earnings yield for the business, which I think is probably the highest among, I would say, large cap companies, or now PayPal's not large cap, but like mid cap to somewhat high cap. Now, free cash flow, they're expecting $5 billion, and again, 20% growth here. And this is going to be the third quarter, which is what the company is going to report tonight. 8% growth in revenue, $7.4 billion in revenue, and non-GAAP EPS growth of 13 to 14%, and between $1.22 and $1.25, with Wall Street expecting EPS to be $1.22 as well, $1.23 basically, and $7.38 billion in revenue. So that's basically in line with what their guidance has been in the past. Now, I want to take you through Visa's earnings as well, because Visa is in a very similar sort of business. Payments volume is very important to Visa as well, and they did see in the fourth quarter the payments volume increased by 9%. So spending and retail sales continues to be very strong in the U.S. and globally as well. So for that reason, I think it's possible that PayPal does report some pretty decent numbers and does come out with some beats after the earnings, but it's really the guidance and the vision. And I'll go over some of the other things as well. So let's just go over that first. So focus on total accounts. I really need to see Alex Chriss mention that their focus is once again going to be on growing total active accounts, because for some reason, Wall Street cares more about total active accounts than earnings or revenue or total payment volume, which are actually the true metrics that should be focused on. Because as long as, total accounts even if total accounts are going down and the revenue is growing, why does that matter? Because engagement is high. So they're basically getting higher quality users as opposed to focusing on quantity and lower quality users, right? So that's basically the give and take between focusing on total accounts versus engagement. But I would much rather prefer for PayPal to focus on both growing total accounts and at the same time growing engagement. So that's going to be that. And then third is going to be obviously the new products that we need to see from PayPal. I mean, there needs to be some type of vision over the next 5 years to keep PayPal relevant and keep its dominance on a global scale when it comes to a payment processor, payment provider, in the world. Because yes, there's a lot of competition coming from FedNow, from Apple, from Amazon, from Google, from a lot of these companies that can just literally enter this space with little to no barriers because they're so big. So PayPal needs to continue to focus on differentiating itself and keeping its unique position on a global scale. As a payment provider. Like I said, I mean, I moved everything from, Payoneer over to PayPal over the last couple months, and I've never been happier because I use their service, I use their product, and it is good, right? I mean, unless Apple Pay and Google Pay comes to here and what I'm doing, like I wouldn't switch from PayPal to anything else at the moment. So let's just quickly run through a free cash flow model. $5 billion is going to be the free cash flows, 5% growth rate. So what I did here is a reverse DCF, trying to figure out, okay, if the current price is equivalent to the intrinsic value, which is both of them are the same at $51 per share, PayPal only needs to grow free cash flows by 5%. That's it, to justify today's valuation. 5%. Like, do we believe that PayPal is going to be able to grow free cash flows by 5% over the next 5 years? I think that's far more conservative, far more reasonable. Discount rate 12%, 3% terminal growth rate, and I've also accounted for a 10% margin of safety. Now, if you take into account a 10%, right? So if you believe that, okay, it's going to be somewhat in the high single digits to somewhat low double digits, 10%, now the fair value jumps to $62 for PayPal. Same, everything else is the same. And if we assume a 0% margin of safety in this example, and still a 10% growth rate with a 12% discount rate, 3% terminal growth rate, and now we're looking at a 34% undervaluation at just under $70 as being the intrinsic value for PayPal. So that's where we are with this company, okay? It is a business, it is a company at the end of the day, which has, I would argue, pretty good numbers, but it continues to get sold off from Wall Street perspective, doesn't seem to have that much of an appeal anymore. But of course, it's getting cheaper and cheaper every single day, considering that it's trading at a 7 year low. But I'd love to know like what you guys think. Of course, from a business standpoint, the numbers are there. The stock price performance is, I think, what most people care about, right? Is how the stock's doing, and that is pretty brutal, down over 84%. But like I said, I think as a long-term investor, our focus needs to be more on the company and the business and how strong the fundamentals are versus the stock price. And sometimes in the short term, yes, you're going to be incorrect. Both ways, right? You could be incorrect both ways. You could think that the company has great fundamentals and the stock price still drops, or you could think the company has poor fundamentals and the stock price could rally. So in the short term, that can happen. And Howard Marks actually talks about this in his book. The most important thing is that short-term performance is probably the worst indicator of any investor's performance, because anything is possible in the short term from a price action standpoint. It's really what happens over the course of 5 years or 10 years out from the time of the analysis what really matters. And I do still believe, like I said, I'm confident if PayPal can execute well, and both PayPal and Enphase, if they can execute well, they have the potential to recover very, very strongly, because business fundamentals are strong, right? And same thing happened with Amazon. Same thing happened with, a lot of tech stocks back in the 1990s and 2000s, because, they were down 80 to 90% from their all-time highs. And just because the stock price was down didn't really mean that the companies were failing. In fact, quite the contrary, right? The companies were actually doing really well, and the stock price eventually did rebound and did incredibly well over the next 20 years. So let me know your thoughts down in the comment section below. Hope you guys enjoyed this video and a quick update and an analysis on PayPal. Big day, lots to unpack after the bell. So drop a like, subscribe to the channel. Link to our Discord and Patreon is going to be down below. As always, happy investing. I'll see you all in the next video.